If your portfolio relies on traditional safety trades or legacy service moats, today's holiday liquidity drain just exposed your hidden risks. The bond market froze first today as political friction at the Federal Reserve collided with thin trading volumes. Then that dollar strength spilled directly into the gold market, while banking regulators quietly prepared to unlock massive amounts of trapped capital. Finally, we will track how the AI scare trade is forcing service providers to hike capital expenditures, and why geopolitical tensions are maintaining a rigid floor under corporate energy costs. Stay with me, and I will translate that into margins and cash. We begin with the macro foundation, where the cost of capital is currently paralyzed by political gridlock and holiday trading mechanics. United States financial markets were closed today in observance of President's Day. When the primary trading centers are closed, the price discovery mechanism weakens, making the broader market highly susceptible to exaggerated moves in foreign exchange and commodities. This thin liquidity amplified the ongoing political friction surrounding the Federal Reserve. Senator Tom Tillis is actively blocking the confirmation hearings for Kevin Warsh, the nominee for Federal Reserve Chair. Tillis insists he will not support any nominee until the Department of Justice drops its investigation into current Chair Jerome Powell. Investors often assume that once a central bank nominee is announced, their specific policy agenda is guaranteed to take effect. Imagine a new chief executive is hired to save a struggling company, but the board of directors refuses to hand over the keys to the building. The market hates the uncertainty of an empty driver's seat. This friction forced the United States dollar index to stabilize near 97, keeping the 10-year Treasury yield hovering stubbornly around 4.05%. This sustained dollar strength immediately attacked the gold market. Spot and futures prices for gold dropped more than 1% today, fighting a fierce battle around the $5,000 per ounce mark. There is a widespread misconception that gold is an absolute, unconditional safe haven against all forms of market fear. However, gold yields no interest. When the dollar reclaims its role as the ultimate safe haven and interest rates remain stubbornly high, holding gold becomes incredibly expensive. It is like holding an umbrella in a hurricane when you could simply walk inside a concrete bunker. The earnings path for this dynamic is twofold. For multinational corporations in the S&P 500, a dollar index sustained at 97 acts as an unlegislated tax on their international revenue. Foreign sales translate into fewer dollars on their quarterly reports, compressing their top-line growth. For highly leveraged companies, the inability to forecast when the Federal Reserve leadership will actually transition forces them to hoard cash defensively, delaying capital expenditures and share buybacks. The checkpoint to remember here is that political friction at the Federal Reserve keeps the ultimate cost of capital stubbornly high, and a strong dollar will aggressively punish non-yielding assets. While the broader market struggles with paralyzed capital costs, a massive cash flow unlock is quietly brewing for the banking sector. Federal Reserve Vice Chair Michelle Bowman recently announced upcoming proposals to significantly change the regulatory capital framework for banks. The goal is to incentivize banks to originate and service mortgages by removing the requirement to deduct mortgage servicing assets from their regulatory capital. Additionally, the proposal seeks to increase the risk sensitivity of mortgage loans based on loan-to-value ratios. A common market misconception assumes that central bank rate cuts are the only mechanism capable of boosting bank lending and systemic liquidity. This ignores the massive impact of regulatory capital requirements. Think of a commercial bank like a massive delivery company. For years, regulators forced this company to keep half of its delivery trucks permanently parked in the garage, just in case of a catastrophic emergency. Even if fuel gets cheaper, they cannot deliver more packages. Bowman's proposal essentially hands the keys back to the bank, allowing them to put those trucks back on the road. The earnings path for this deregulation is direct and highly lucrative. Banks hold substantial numbers of mortgages with extremely low loan-to-value ratios. Currently, they are forced to hold disproportionately high capital against these very safe loans. By freeing up this dead capital, banks instantly improve their unencumbered free cash flow. This newly liberated cash does not just sit in a vault. It translates directly into expanded lending capacity, higher net interest margins, and significantly increased share buyback programs. The checkpoint here is that regulatory deregulation acts as a shadow rate cut for the financial sector, rapidly expanding their return on equity. As banks prepare for a capital unlock, traditional knowledge work sectors are facing an existential margin threat from the AI scare trade. Over the past few days, a widespread sell-off ripped through software, real estate, and financial services. Startups unveiled new artificial intelligence tools for tax planning and insurance quoting, causing shares of major brokerage and insurance firms to take heavy hits. Investors incorrectly assume that artificial intelligence only benefits the massive technology companies building the foundational models. Consider the invention of the commercial tractor. The tractor manufacturer makes a fortune, but the thousands of manual farm laborers suddenly find their primary value wiped out overnight. The earnings path for these legacy service providers is under immediate threat. Firms like insurance brokers rely on immense human capital to acquire clients and process complex paperwork. If a new application can execute those exact tasks for a fraction of the cost, the legacy firm permanently loses its pricing power. To defend their free cash flow, these legacy companies are now forced into a painful corner. They must drastically increase their own capital expenditures to build competing digital tools internally. This burns massive amounts of cash today, while simultaneously fighting off cheaper competitors that compress their top-line revenue. The checkpoint is that artificial intelligence is rapidly transitioning from a technology tailwind into a severe margin threat for the service sector. Finally, we must look at the physical foundation of the economy, where geopolitical tensions are maintaining a rigid floor under corporate operating costs. West Texas Intermediate crude oil is currently trading firmly above $63 a barrel. The market is watching closely as the United States and Iran prepare for a second round of nuclear talks in Geneva tomorrow. There is a dangerous misconception that simply scheduling a diplomatic meeting guarantees sanctions will vanish, and cheap oil will flood the market. It is like two rival business owners agreeing to meet for coffee. A meeting does not mean a merger is signed. It just means they are talking while keeping their lawyers on speed dial. The earnings path for the logistics sector reflects this exact tension. The United States has dispatched a second aircraft carrier to the region, preparing for the possibility that talks fail. This military posturing embeds a strict geopolitical risk premium into every single barrel of crude. For airlines and parcel carriers, this artificial price floor directly threatens free cash flow. Until a definitive agreement is reached, these companies cannot assume any relief in their operating expenses. They must continue to push fuel surcharges onto consumers, which risks destroying demand, or they must absorb the costs internally and watch their margins compress. The final checkpoint is that geopolitical tension is maintaining an artificial floor under corporate energy costs, ruthlessly punishing companies without pricing power. The macro landscape today is defined by disruption, regulatory shifts, and political delay. Watch how the 10-year Treasury reacts tomorrow when full market liquidity returns. This report is for informational purposes only and does not constitute investment advice. Make sure to subscribe to keep tracking the path from macro noise to micro cash flow.